Welcome to Thursday, August 4th, Crypto Answered. We're here every Thursday, sometimes at 7 p.m. Eastern Time, sometimes at 2 p.m. Eastern Standard Time, just so we can get every single person in the world access at different times. I know some people on the other side of the globe, this is quite late for them. So thank you, everybody that's tuned in here as listeners to Crypto Answered. My name is Kellam, your host. You can find any information out about me if you're listening here or on the podcast that we have now officially started with our partner PennyFly Entertainment, which will be going out about a day or two after this. The recording of this will be going out about a day or two after this live discussion here on Twitter Spaces. We've got a number of excellent guests that are I'm really excited about having here on Crypto Answered. So please, everybody that's tuned in, first again, thank you for joining. Please give every one of these panelists that come up on stage and sharing their time and their wisdom and their experience with us, please at least check out their pages. Rather than me read off what their socials are, as I bring them up on stage, I'll have them tell you where you can find information about them. So please check them out. Again, my name's Kelly Kellam, your host here on Crypto Answered. You can find my information at Kelly Kellam, which is KELLYKELLAM. If you're listening on one of the podcast areas, I do recommend you come and checking out all these profiles of all these people on their Twitters. That's really how all of us have connected, and there's so much great information with all these people. So before we get started, I just want to bring up and introduce my enigmatic co-host and wonderful friend, Mr. Dr. Harry J. Malinsky, known as CryptoVet. How you doing, good sir?
Man, I'm doing absolutely wonderful, dude. It's going to be a good day. We got some good speakers. We're on early, so, we can talk about some stuff. And yeah, if we have time, we'll get some speakers on here. So I'm super excited, Glad to be here.
Sorry about that. It's having an issue on my phone end. But rather than me give a rundown of anything on the markets, all these things are going to be covered throughout the entire discussion today. So we'll just go ahead and jump right on in with this and then bring up our first guest, who is incredibly smart, crypto enthusiast, investor, entrepreneur, trader. And he gives so much to the space. We're going to be bringing up Mr. Crypto Burb, who's I think this is the second time on our show. Really appreciate having you here. And how you feeling? What are you seeing in the charts? What's on your mind? And before you jump into any of that, where can people find you on online, on your socials, on your websites, anything that you're offering?
Hi, Kelly. Hi, everybody. I'm happy to be here. So my name is Adrian CryptoBurb. I'm a technical analyst. I'm a trader. So, most of the stuff I actually do and share is basically trading related. All right. At times I post some shit posts, memes, and I've been trading crypto since 2017. I'd heard crypto basically first time when my programmer's friend kind of like talked to me about that in 2014, freshly after the anti-gox collapse. He was on maths of the geeks, of the biggest geeks, because that's who kind of like got into Bitcoin at that time. And I'm super excited to share some knowledge. There were too many questions to answer all of them in a pile. However, I'm happy to walk you through, guys, with a couple of chart insights and whatnot.
I really appreciate that. I appreciate you coming on, and I appreciate you sharing your time. So I'm going to go ahead and I'm going to let you take it away from here because I know you have a little bit of a time window, Adrian. So I'll just go ahead and throw the first question at you. Right now, of course, we've had the FOMC meetings, which I don't think anybody or the majority of people that are in crypto, uh, you know, maybe I'm just speaking about myself, but I never followed any of this sort of stuff before I got so heavily involved in investing and trading in crypto. Now I feel like I've basically been taking economics and geopolitical markets, and I mean, 101 like doctorate program course in the last few years, learning about all this stuff. And we've been, especially with this runaway inflation we've had in the last this last year and a half, that now the Fed is trying to in some sort of incomprehensible way with their ineffective means tamp down this inflation. We seem to be in this vacuum sort of period right now for the next 2 months until we get any more clarity on what they're going to be doing. It's very, very speculative about what can happen. So with the market looking like it's trying to form some sort of a bottom, we can't necessarily say it absolutely has bottomed structurally until we see a couple more developments on the charts that are critical. But how are you approaching this market right now with balancing hope with actual data and what you're seeing? What sort of methods are you doing to approach this market?
Gotcha. Yeah, there is a couple of those, and you've actually already broken it down somehow. So I could already pause here and kind of like pass on. But I do believe that that with cryptocurrency, as a market, as a financial market class, being of course more and more adopted, you do get more eyes to it, right? As it becomes this kind of like traditional market somehow a little bit, right? So there is you can tell that by observing the correlation between the markets right now. On average, on the 7 week basis, the correlation has remained very, very strong for Bitcoin for the past couple of months, to be honest, right? And the correlation tends to peak especially when the markets like when the markets sink, when they go down, right? When the ship goes down, uh, there is this kind of like a Murphy law to it, as in tiny, tiny details, elements which are not correlated at all. When one takes a lead and dumps, the entire, pool of these elements all of a sudden starts correlating with each other, and there is this chain reaction that one dump causes the entire, at time global economy to dump, right? That's the Spotify effect or whatever you name that. And in all honesty, of course, it's mostly unpredictable, right? Anybody who's going to tell you that you could have predicted, COVID pandemic with Bitcoin chart because there was some bullshit pattern, or something, like they are suffering from hindsight bias, right? Where everything is always in a hindsight. Like they would tell you, yeah, I was so good. I had such an amazing knowledge source, right? I had been unbeatable trader, right? And that's not how it works, right? This definitely comes in and then definitely plays this overconfidence, which is very dangerous to many traders. So the way you ask me, how I play that. So we do get this bear market kind of like a recession vibes, right? We of course had been had been letting the markets leak, for the past couple of months, ever since 2022 started, ever since basically all the Congress people, in US sold off their bags. That was the January time, right ahead of these, war in Russia Ukraine side. So there's this insider trading that we cannot ever beat, right? Despite it's illegal, despite they should not ever be allowed to trade based on insider information, that they basically comprise and create the laws for it and regulations. But the reality is there are insiders. There are traders who will take advantage and who will have this better position, right? Leaving everybody else in an information asymmetry. So the question is how to the question for how, or actually the answer for how to take it, how to play it is, well, how well you're going to respond to this information asymmetry that you have, right? There is this wise saying that would always tell you, like, don't fight the tape, don't fight the trend, or don't fight the Fed. So right now we are in a situation where Fed is in the rate hiking cycle. It's actually boosting rates, at a historical tempo, if you will, right? 75 basis points for the second time, and correct me if I'm wrong, but I think it hadn't been the case for the past 40 years or so. So uh, it's pretty unusual, and the way I would refer to it, to this overall bear market, uh, which is pretty extraordinary, and the recession vibes that you're all having confirmed right now, it's I would simply put it and frame it as a once in generation situation, right? These types of situations, as in the pandemics, like the wars, you're only missing this like a Martian attack, right, or an asteroid crashing into Earth or something like that, just to make it a whole. Uh, but like this is once in generation situation, and this is extraordinary. This is unusual. You don't get that type of situations going on globally all at the same time too often, basically. So unusual situations require unusual setup or preparations to it, right? And uh, In all honesty, throughout the later stages of 2021, when the market was really doing well, I was very open about gradual leaving crypto, right? I never left for good. I still was caught off guard, of course, with the every grand news that peaked out the markets, in November, early November 7th or something. Uh, so it's impossible to time the markets well many times in a row, because it takes it's not even luck. It takes this statistical advantage that is impossible to have, right? Um, and I would argue that ever since this kind of like quarter four started for 2021, I had scaled, you know I was really focused on scaling out of crypto, right? The higher it went, I was scaling out outside crypto to real estate, to other markets, to cash, of course, to metals, to even like some jewelry, right? Which actually performed much better than anything I had. So I was really focused on distributing profits out of crypto, right? To decrease my weight of the overall portfolio, because that's exactly how I look at it. The crypto side is just an asset class. It's just an asset class. It's not the asset class. It's not the holy grail. It's not something that I'm going to have all in or all out at any times. Instead, it is just a asset class, right? Just next to other financial markets, next to commodities, next to other like metals, stocks, whatever. So, and when there's this diversity question or diversification, well, that where the portfolio management, kind of like insights come in. And there is a question of what leads what, right? Which markets are leading? There is like this portfolio management practice, so that, well, professional money managers, portfolio managers would basically try to stay overweight on assets which are performing better, right? And underweight on assets that are performing poorly, because there is this, not a paradigm but an actual observation and phenomenon in the market called momentum. And momentum trading and momentum investing overall, you know relies on a very interesting observation. It is actually one observed, if I'm not mistaken, ever since Victorian age in UK. This was like, 2000, 200 years, over 200 years, 212 years, something like that, of registered, like recorded, historical performance for momentum traders to be actually performing the best, or the best with combination to value investing, like in 60/40 split for portfolio, whatever. Not getting into money details, right? Because it's of course hard to compress much knowledge in a short period of time. I'd say that staying out overweight in your portfolio, putting more weight to assets that are performing well, this typically is going to make more money to you than shorting those, for instance, right? And the reason is that there is this momentum, and the momentum just means persistence. Just like you would have with the second, Newtonian laws of physics, when there is this momentum, basically, principle, right? So when you put an object into movement, right, and it starts moving because of some force existence, it will keep moving until there's an opposing force somewhere, right? Be the drag force or some wall, whatever. So the same happens with the markets. It's money moving the markets towards certain direction, usually built based upon future expectations, right? The future expectations, imagined prices, is exactly what drives the markets. And often they roll on the self-fulfilling prophecy basis, right? Because certain patterns, you know, may not exist. Many people would read about it in the books, and they would try to incorporate the knowledge and employ certain patterns, techniques, and practices, which actually makes them work eventually, which is a funny concept on its own. And then the trends are fractals, right? Which means that they are self-complex. They are infinitely complex. The large trends, primary trends, as in right now the bear market, consists of secondary movements and secondary tides, right? And those secondary tides consist of even tertiary movements, which are considered like some daily fluctuations or noise. And getting this broader, kind of like understanding of how the markets work actually lets you understand that what we are looking at right now in the markets is just a secondary tide. The primary tide, the primary wave, is downwards right now. We are in the bear market, right? So even if the market is going up right now, you have all the 200-day averages basically, still trending downwards, sloping downwards. And this is how we define the bear market rally. So I'm not escaped. I've not escaped out of my bear market portfolio tactics and focus. I focus on not spending much, not on overspending. Uh, I take preservation and capital protection first when there is a bear market, because even when there is an upward spark or something positive, it's supposed to be short lived. So I approach this with a little bit of distrust.
No, I think that's a great sort of consideration, and I think one of the things that plagued myself, and I think a lot of people when they get into any sort of investing or trading for the first time, is that one, people that jump in, they start trading too soon without understanding the basic principles of investing. And two, we get, especially if you're invested in something or just started investing in something, it's especially something as exciting as Bitcoin in the crypto markets, and the perceived and very likely, although still perceived, long-term upward trajectory that many, but not all, not most of these projects are going to take in the next 10, 20, 30 years, as they displace a lot of current systems. That we think that when we have this downtrend like we've had right now, the second it starts going up, people think, okay, I just need to jump in right in the middle of a push move, not waiting for even like the smallest, finding support on any sort of local sort of support and resistances from horizontal price action lines or anything like that. But or another thing is, when you see the price moving down $50, I'll be on YouTube streams watching comments, and people are like, Bitcoin's dumping right now, or vice versa. Coin moves up, $100, or a quarter of a thousandth of a percent, and people go, oh, it's pumping hard. It's like, well, I mean, look at it in context of how large the asset class is and what the percentage move is, and we need to be patient for the basic structures to develop on a chart so that we can actually make those big movements right now. And so not trying to catch a bottom or not trying to catch a top. And so thinking about, as you said, the primary trend and the secondary trend, and then also the tertiary, the third trend there, which a lot of times a movement will start on and people will make moves on it like it's a primary trend move. It doesn't work out in the long run for consistency of profits. I think the biggest disservice most people can have is joining the crypto markets when it's in a bull market, because you get a lot of bad habits that are reinforced by lucky wins, or even in a in a bear market like some will buy just a little bit on luck on getting a little bit of a move on something, and then they'll make the same sort of move on their second trade or the third trade, and wonder why it went the other direction. So it really speaks to how much patience is needed on that. I know you're going to have to go here in a second. So, is there anything else that you wanted to sort of talk about, and specifically less on the macro? Any levels that you're watching right now on, let's say, if you're staring at a 4-hour chart, what current levels you're looking at holding or breaking, and anything that you're seeing right now?
Yeah, so I'll have about 7-8 minutes, so I can stay as long as that. Uh, thanks for the question. I do believe that, of course, while having a look at the lower time frames, uh, the most important point is to understand that we are moving, well, within a trend, right? And we have to define a trend. And the trend right now is sloping upwards a little bit. However, it's just like one of the tweets that is right there in the spaces somehow pinned. It is a little bit of sideways deemed, as in the prices move up for Bitcoin on the 4-hour chart, but they move up barely, right? Which tells me this is corrective wave. This is not a fully developed trend just yet for Bitcoin. And factually, Bitcoin uh, has been strongly underperforming, against the S&P 500, just even that, right? Not to even mention all the stocks that are leading right now. because we do have this consumer discretionary kind of like stocks, pumping on the XLY side for the sector. You'll have the cyclical stocks overall, which is the consumer, the communication services, the technology, which are all not leading just yet, but they are right there at the edge of kind of like breaking into a leading quadrant, if you will. One of the tweets also does regard the RRG, which is the relative rotation graph. There's this table, right? I think it's one of the tweets. Just feel free to look it up. And there's this amazing concept actually of relative momentum, relative strength, right? Which are the things that I observe in order to get and gain the knowledge on the portfolio management side. So right now, if you have a look at the RRG chart, which is somewhere posted as well, you're looking at strong underperformance of Bitcoin against the S&P 500 and against other stocks which are right now gaining on the relative momentum. Relative because it is related to S&P 500. So S&P 500 is a benchmark. So the cyclical stocks are not yet broken above the above the S&P 500. The ratio is not there yet, basically. However, it's accelerating, right? So it's a very promising sign because it means what there is acceleration on the relative strength and the relative momentum side against the S&P 500. It means that most likely it's going to eventually become leader, and this is exactly what we want to see within the bear market rally. It's led by cyclical stocks, right? However, it's still a tide, that is secondary within the larger bear market. So knowing that Bitcoin has been underperforming, you know, is exactly showing this weakness. While on the cyclical stocks, let's say that the momentum is quite apparent and you can tell there is a follow through on the prices. There is a sequence of higher highs and higher lows. But at the same time, there's enough of this demand layer building up at each low, right? That you don't really get too much of this penetration once a new high is made, right? For Bitcoin, it is in a way that it breaks above this $24,000, and there's a lot of weakness. There is a little bit of persistence, like at first, but then it fades away, and you get this breach below the fully built support right about. And you know, and this means if it is repetitive, and it is, then this tells me we're in the corrective wave. So I do not necessarily see Bitcoin as fairly safe because A, it has been underperforming. B, it's making moves within this corrective wave to the upside. And C, it's lacking this momentum. It means that money is not there yet, right? Uh, so I would say that especially with a little bit of a dollar increase today, or the geopolitical risks, with Taiwan and China, just there's so much going on, and each and every single small pieces, when gathered all together, they really make impact on the markets. And that's what I think we're looking at right now. There is little appetite on for Bitcoin, in my opinion, and this is well reflected in the prices. So I think again that through the proxy of correlation, Bitcoin may eventually catch up with those cyclical stocks, right, with the S&P 500. However, it's a process, and this process is vulnerable, and it's literally there is this upward trend, basically bouncing ever since getting this local bottom at 17,500. If it is a bottom, I'm not necessarily convinced. uh, Finally, Bitcoin tends to basically print drawdowns of about 90%, 80 to 90% of the peaks, right? This is definitely one of the weirdest market cycles we've had on Bitcoin so far. um, but overall, you're looking right now peak to trough to 75% drawdown, right? So even if it corrected, just like shot up immediately, it would be probably not because of some major technical reasons, but rather from exogenous signals, which may happen, right? There might be, just like you would have with this BlackRock and Coinbase, there might be some big player coming up, just like Elon Musk did with Tesla last year, right? And then April. So I'm not saying no to that. I'm ready for such a solution. I'm definitely not short Bitcoin, right? If anything, I'm underweight, right? And underweight is a little bit of economic equivalent to short. I don't need to short on leverage, right? For my portfolio, it's okay if I just have less Bitcoin at certain time and more weight towards some other assets which are performing better. So that's my overall approach. And yeah, I can cover one last short question if there is any.
No, I mean, I think that's a great approach, and I really like I like that you're pointing out to anybody that maybe this is new to them, maybe it's just a reinforcing thought, but it's important that you're talking essentially about the importance of diversity here, and you talked about scaling out a lot of your positions, whether it was because you saw something in the chart or you saw something in other charts, but you got yourself in a position that you didn't get absolutely destroyed in this drawdown because you had broad market exposure and you were reallocating within your entire portfolio that made the most sense at the time based on technicals, not just on Bitcoin or on Ethereum, but on as those assets relate to other assets, the positioning of those assets within your portfolio. And I think that's brilliant. One of the things I wanted to point out, and I just wanted to hear your thoughts on it, and we can wrap out your segment. And again, I thank you for coming on. Anybody that hadn't followed him, definitely go check him out at crypto_burb, BIRB. Wonderful information, newsletter, signals. I mean, he's got so much going on, so definitely give him a check. But the last thing I wanted to wrap out on is I shared a tweet up in the top in the nest. I was looking at this bullish structure or potentially bullish structure on Bitcoin with this sort of 4-hour parabola that you're talking about, where it's kind of just bouncing up. A lot of people are getting really excited as if the entire bias of the market is now going to be rocketing bullish. But looking at the broader market, in that same tweet, I was comparing the dollar index basically right at its resistance and extended sort of bear flag or descending channel, however you want to draw it, as well as having the S&P 500, the Dow Jones, and then I use Micron as sort of a tech stock example. All of them in very bearish sort of ascending wedge setups right now. With the Dixie setup in a very bullish sort of setup, while Bitcoin is set up in a potentially bullish structure, which it's already sort of breaking down and from a little bit on basically bearish break. So I'm just curious your thought if that sort of supports what you're saying, or if basically how you're looking at these Dow Jones, S&P, tech stocks, and Dixie in relation to in relationship to what's going on with Bitcoin.
Gotcha. And that is still a question to me, right?
Yeah. Just just
Okay.
kind of wrap you out.
Okay.
And step out.
Gotcha. Yeah. Well, of course, dollar is in a bull market, right? So, again, to define the bull market or bear market, you just look up 200-day average and see if it's sloping upwards or downwards. It's as easy as that, right? You cannot confuse that. So when dollar is, basically getting stronger, and it is, we are looking at this 30, 40-year downtrend, kind of like following through to the upside for the first time in ages. On the dollar side, right, we closed the month above a critical resistance of 104 points for the dollar index, and this definitely kind of like dries up the markets a little bit, of the liquidity, which again makes it easier for them to fall, right, because there is no demand holding it upwards. So I would say again that amid the recession fears, which people start kind of like realizing they are factual and they are real, right? We know there was high chances of recession basically coming because of inverted yield curve, right? When the 10 years, minus 2 years would basically go for the difference below zero, and whenever it does, this disparity kind of like combined with high energy prices are typically leading indicators for a recession 6 to 9 months following. And this is exactly the case, right? So with the recession ahead, there is a little bit of more downside to the markets, the business cycle turning down right off the inflection point we just had, right? You remember when Jay Powell on the FOMC meeting said he didn't believe they had U.S. recession at that time of his speaking, but a couple of hours later, the recession was confirmed, right? But second consecutive, consequent kind of like fall in the GDP
Yeah.
on the negative side. So yeah, closing off, from my side, I'm just saying, that there is a lot of uncertainty, of course, from geopolitical risks, which will correlate the markets altogether, even if they are not correlated. just like we had in COVID when everything was dropping, gold, silver, like Bitcoin, stocks, whatever. And I still believe we have more downside, but my beliefs have nothing to do with real price action. It's not kind of like correlated at all. It doesn't really come. My thoughts don't matter in the market. That's what I'm saying. And typically, like I said, as the recession starts, you would have still a little bit of more pain to come for the financial market. So probably not bottom just yet. I'm still again ready and holding cash position to get in if there is some major drop. I had made some entries, of course, but it's not definite just yet. So I'm waiting, letting the market resolve a little bit, and probably quarter 4 is going to be stronger, supported by seasonality. That's what my personal opinion is, however relevant it becomes. And thank you all for listening, guys. Cheers.
Oh man, I really appreciate that, and thank you for your time. I know you got a lot going on, and you're across the ocean. I'm sorry we didn't get to link up while my wife and I were in Portugal a few weeks ago, but I'm sure at some point.
Don't worry, we'll
I'm
catch.
Yeah, I'm sure we'll be sharing some sunshine at some point. But again, big love to you, and everybody. Please go and check out his profile. Give him a follow. Tag him in a couple messages. Let people know that this guy is a great guy to follow. So thank you for joining us, Adrian.
I appreciate you. Love you all, guys, and great guests coming up as well. So tune in. God bless. Bye bye.
Bye bye, Crypto Burb. All righty, now with that, we're going to keep the show rolling. Thank you everybody so much for tuning in here on Crypto Answered. If you've tuned in since we started, my name is Kellam. This is brought to you by PennyFly Entertainment. Got my co-host here, CryptoVet. For anybody that hadn't heard yet, we are going to be. This will be being released on podcasts as well on all the major podcast outlets. So be keeping a lookout for Crypto Answered there. And you can follow me at Kelly Kellam. And next up, we got a guest I've been trying to bring on for a while, and I'm really glad we got to bring him on this one. This is Mr. Gert Van Loggen. So happy to have him on here. This is a first time guest. So how you doing? And anything that you're thinking about the markets, anything you think or you either agree or disagree with what Crypto Burb said. And also before I get into that, for all you listening, whether here on Twitter or on the podcast, you can follow him at Gert Van Loggen, which is spelled just like it sounds. So how you doing, Mr. Gert? How you feeling? What are you seeing?
Hi, thanks for having me tonight. Um, yeah, um, I I'm currently at a holiday in France, so it's a bit in the middle of a holiday. So, but I'm still following the markets, of course. What I've been looking at is indeed the inverted yield curve. Crypto Burp mentioned. Um, the thing with the inverted yield curve is, interestingly, that in, when it inverts, the last two times we saw a blow off top just after that, and when it bounced back, like in the normal position, the yield curve spread basically. We saw the recession kicking in, so I think there will be a blow off top for the S&P 500 together with the crypto markets, based on that. And then a big recession coming in, like the one in 2000 and 2008. Unfortunately, I can't share my screen with you, so I have to talk about the charts without you seeing them. But maybe the future can be later implemented in Twitter Spaces as well.
If you have Gert, if you have any of those as tweets, I'll go through your Twitter right now and I'll share the tweets up in the top for anybody to see any of the snapshots in the images. I see CryptoVet's doing that right now.
Ah, all right. Yes. Also, there are big concerns of the Fed doing things, of course, as tightening their balance sheet. And well, what I've seen is that they just sold about 20 billion in assets on the portfolio of 9 trillion. So that's really modest. Also, the last time they were tightening their balance sheet together with the increasing their rates, we had 2017 bull market of Bitcoin and the S&P 500 as well, rallying upwards. So I'm not led by those how do you say Fed narratives that when they decrease the balance, that instantly all markets will react. As we have seen, is the S&P 500 is close to printing a major higher high, not breaking the all-time high yet, but well, certainly breaking out of a bearish downtrend at the moment. Also, Bitcoin ranging up from 17,500. The thing with Bitcoin is that when it drops below 14K, say it's the top in 2019, then the bullish structure fails and not be above that. So we're still in a big uptrend since the 2018 bull market, and since then we had two major bear markets. The first one in 2020, of course, the COVID dip, and the second now, which both last about a year and a half and are of the same order of magnitude in terms of time. So in terms of Elliott waves, there are also always in a bull market two major corrections. The first was really sharp, so we went up all the way from $3,000 up to 12,000. Then we came back to 4,000, basically all the way down, and then we had the major bull market since the COVID dip, going from 4,000 up to 69,000, and it hasn't dropped below the 2019 top of 12,000 or 13,000 yet. So it can still be considered as a second correction wave of this bull market structure, implying that there will be a final wave up is needed. So that's basically, in short, my view on the market currently.
So let me ask you a question. You were talking about the inverted yield curves on the 10-year bonds, and I'm just curious how you're talking about the blow-off tops following that with the S&P 500, and then also likely Bitcoin as well. What's your sort of? Do you feel like we're in the middle of that sort of that correction now, or do you think that we're still going to in that sort of thesis that you're presenting? Are you thinking that we're going to have a very strong push up and then a blow off from there?
Well, I think there will be a very strong push up, a final wave, but the wave has to be counted as well up, because waves of smaller, say the 5 wave itself is a Elliott wave itself. So, well, it could go as high as 69,000, and the resistance which lies there could return it into the real bear market. But the thing is that there has not been yet a clear fifth wave during this bull market since the drop in 2018. Also, if you look at the net unrealized profit and loss, the NUPL, you can see that we have a similar pain level as in March 2020, but not comparable with the bear market in 2018, signifying that this correction is of a lesser magnitude than the one we had in 2018. The price level I'm closely watching is 13,800. When BTC drops below that, then we have a major breakdown, and well, that's basically the invalidation point for my thesis.
Well, no, yeah, and again, I want to thank you for coming on and joining. We're going to continue this roundtable discussion, so definitely stick around.
Thanks.
We're going to go back and forth with a couple of the other panelists, and then just for anybody that's tuned in here on Crypto Answered, in about 20-25 minutes or so, we are going to be trying to bring a couple people up on stage. So if you have any thoughts or comments on the market, just be prepared to request, and we'll try to get a few people up here at the end. But you know, before we do that, definitely go and give Gert a follow. Check out his profile. It's at GERTVANLAGEN. He's got a lot of great content he shares on a daily basis around traditional markets as well as crypto and all that good stuff. So I want to pivot here to Mr. Plan C. He's basically one of our good friends and residents here. He's on almost every week. Only a few weeks since he started that he's missed just because life. We're all juggling too many things in life, as I'm sure all of you all listening are as well. So, Mr. Plancy, how are you feeling? What are your thoughts on anything that's been said, or is there any other things that you wanted to share? I know we got a lot of charts we're going to share from you. So please feel free to reference those, and anybody that's following along. If you scroll up to the top, if you expand this Twitter Spaces window, you'll see we're sharing a lot of the different charts and tweets from the people as they speak, so you can follow along with what they're doing. So please do that. Plancy, on to you, brother.
Yeah, thanks. Thanks again, Kelly, and thanks CryptoVet for having me on. It's a great show every week. I really enjoy it. And yeah, it was nice to hear Bird and Gert's takes on the market. Really enjoyed just hanging out, listening. Yeah, just a couple things to share. So one is I might have been the best bottom signal to the market. It remains to be seen, but potentially I was the best bottom signal in my derailing of going off about Celsius network for a couple of weeks and getting away from the charts like I'm normally doing. So yeah, that we'll see in hindsight if that's the case, but the timing on that was interesting. And then yeah, but yeah, I'm fully back on the charts now and really enjoying getting back into it. And I mean, like, as far as like the macro stuff goes, I mean, there's really no point in me speaking to it. There's so many more knowledgeable people than myself. Caleb's on stage here, and I host a show with him called Macro Mondays on Twitter Spaces as well. And yeah, just being on there listening to his insights is one of the ways that I'm trying to keep up with the macro mainly. But as far as myself and what I'm focused on currently, you know, there's a lot of like, I agree with a lot of what's been said with Bird and everyone who's spoken. You know, it's I understand, like, a lot of people are thinking, okay, this time's different, you know, throw out all the charts, like, just focus on the Fed hiking and what's going on with the Fed. But, you know, although, of course, I believe that's very important and that's a huge factor in the markets, I still do feel a lot of these cyclical patterns in the on-chain and the TA, I mean, until they fully break, or they're invalidated, I don't know why you would not consider them and take them into weight them at least to some degree. So what I've been focused on myself with the on-chain right now is assessing the degree of capitulation we've already seen up until this point and compare that to, you know, the whole history of Bitcoin and all the previous cycles, because a lot of us just weren't here for the previous cycles. And so, you know, it's very easy for a lot of us to think like, oh, this time is completely different. And like, you know, it's just not worth comparing to these previous cycles. But, you know, we have to factor in that these previous cycles, like I said, a lot of us weren't here. And there was definitely a lot of narratives at the time, you know, that were on par in different ways with what's going on currently. You know, there was crypto as a whole was just not even close to the level of adoption and consideration from big players globally. So there was a lot of like uncertainty of if crypto would even survive and come back. I mean, there's a lot of hacks going on today still, unfortunately, but there was a lot going on back then as well. So anyways, it's just, I think it's important to, you know, even though we weren't there for maybe some of these previous bear markets, to consider that these same questions and these same levels of fear existed back then. So let's just compare on a fair assessment through different metrics. How much capitulation have we already seen versus previous cycles? So I'll go through a few quick charts. One is I've been focused on is looking at a metric called SOPRA, spend output profit ratio. And so you know, anyone can just go on Google and look up and kind of look at the definition of that metric. But it's an on-chain metric, and it's essentially looking at when a coin last moved, you know, what was its value, and when it's moving now, what's the ratio basically? So like if a coin is being spent at say 20K and it was bought at 40K, the spent output profit ratio on that would be 0.5. So for that transaction, it'd be 0.5. Now that'd be weighted and combined with every single other transaction that day to get like an aggregated metric for that spent output profit ratio for that single day. And then you can do moving averages over different lengths of time. So what I've done is I've looked at the last 100 days of the spent output profit ratio for the entire network. And historically speaking, we've spent less than 5% of the days throughout the entire history of Bitcoin below 0.95 on that spent output profit ratio. So just to give you an idea quickly, in the 2011 bear market, we only spent 10 days in aggregate below 0.95 on the spent output profit ratio on that 100-day EMA. In the 2015 cycle, we spent 31 days, 2018, 117, and so far in 2022, we spent 50 days. So it seems like it's increasing, but it's such few data points, it's hard to know for sure. But the point is we're at 50 days already below. And if you look at the combined amount of days in the history of Bitcoin, we've only spent 208 days out of 4,400 days. So less than 5% of the entire history has been below that 0.95, and we're at 0.935 currently. So that's one indication of capitulation over the last 100 days that is rivaling all the previous bear markets, the last 3 bear markets. So you kind of say, okay, check mark, we're seeing the same patterns on that front. And I mean, if somebody would have DCA'd over that 5% of days, you would have done extremely well, obviously, in hindsight. We're looking at these metrics in hindsight, but we don't know if these patterns will continue to hold. Of course, none of this is financial advice. This is just data. But yeah, this is one metric to consider. The next one I'll go through, and then this will be the last one for now, is basically looking at the realized losses. So realized losses is different than unrealized losses. Paper gains and losses versus actually someone selling. When you realize a loss, you're actually selling, versus like other metrics where you can look at, okay, on paper, where's the network at? But yeah, with realized losses, and if you denominate it in Bitcoin, which I believe, well, it's the only way you can really compare all the previous cycles, because if you do it in dollar terms, obviously the market caps increased so much for Bitcoin that you just can't compare. And the largest amount of losses are going to be always the most recent with the higher market caps. But yeah, if you look at it in Bitcoin denominated terms, if we look at the last 90 days of combined realized losses denominated in Bitcoin, over the last 90 days, we're actually above 3 million Bitcoin in losses, or denominated Bitcoin, as far as losses go. And that's only happened, this is the 3rd time in the history of Bitcoin that that's occurred. The only other 2 times where we saw 3 million denominated losses of Bitcoin over a 90-day span were the bottom of the 2018 bear market and the bottom of the 2011 bear market. So it's only happened twice in history besides the recent 90 days. So that right there tells you this is extreme capitulation of realized losses denominated in Bitcoin over the last 90 days. And on that same metric, if you look at it over a 14-day window to look at more like a peak capitulation, we've already seen the 5th. So for only 5 times in history. So I'm just pulling up the chart here. Sorry, guys. Last thing I'll mention here. Where is it? Okay. So yeah. So basically, only 5 times in history. Oh, geez, there it is. Okay. 5 times in history have we seen over a 14-day window. So we talked about the 90-day window. Only 3 times in history has it gone over 3 million coins. Well, only for 5 times in history have we gone over 1 million coins of losses over a 14-day window, over 2 weeks. And that happened on the drop down to 17.6. There was a 2-week window there about a month and a half ago where we had over 1 million Bitcoin of losses. Now, that only happened during COVID, happened during the 2018 bear market, happened just after the first peak of 2013 double top, and it happened during the 2011 bear market. So those are the 5 biggest, could say capitulation events over a 2-week span. And we basically just experienced that already. So that's the last thing I'll mention. But yeah, just wanted to share, some data points showing that, the capitulation we've already seen is at historic levels and comparable to all the previous bear markets, I would argue. The question is, we talked about this last week, I believe, to do with how the order books are pretty, No, that's on the sell side, right? I'm talking about capitulation. I'm talking about the sell side, but on the demand side, I mean, we just might hang out here for a while because we just might, even though there might not be many sellers left that aren't going to be forced sellers. All the weekends have essentially been shaken out, minus the ones that might have to sell, unfortunately, as far as like forced sellers. But besides the forced sellers that might still come, yeah, my point is I think that a lot of these weekends have already been shaken out over the last 9 months. But the question is, when's the demand going to come in? And with the order book so thin, of course we can still have another retest of the lows. But yeah, that's pretty much it.
Well, let me ask you a question about that because one of the things that we've all been, especially anybody that's been following any sort of on-chain data, we've all sort of recognized that it led. I think our analysis was led astray because we were comparing. First off, we weren't prepared for the recession to come in as it has, and we're looking at the metrics, not really fully under. And this is throughout the community. There's a large majority of people that didn't take into account the different dynamics of how the different dynamics Bitcoin was facing in terms of the global context, with what's going on geopolitically, what's going on economically, what's going on with inflation, what's going on with all these different things. And thus, the markets have gone lower than and further than we had expected. Like when we were thinking in November, a lot of people were thinking it was going to be a small corrective wave and then back up and away. And of course, in hindsight, of course, we're all, the majority of people were wrong. There were some people that called it, but the large majority of people misread that. But I do see the silver lining in it, in that it was an absolutely incredibly wonderful learning experience that was necessary for a lot of people. But with that being said, do you think, with a lot of the metrics being as overheated as they are, and the risk matrix that looks like we're in this asymmetric risk to reward sort of set up an incredible buy opportunity, do you think that any of these metrics are potentially uh, skewed in some aspect because of the amount of big money players that have been involved or got involved last year? That whether it be Tesla having, Elon Musk and Tesla selling, a huge amount of Bitcoin, almost $1 billion worth, as and coupled with the crypto contagion from Luna collapsing, and then that sort of cascading and domino affecting into a number of other major organizations like Three Arrows Capital, uh, Celsius, all these things that were basically poorly risk managed, and just had all this money that's sort of evaporated essentially as the market sort of melted down. And I can't help but think that has some sort of effect on a lot of these metrics that we're looking at. And my question around that is, before we pass it on to Mr. Caleb Franzen, I'm just curious, Plan C, do you feel like the metrics as we see them now, it doesn't matter how those metrics were pushed down, whether it was from institutional, from this contagion versus full capitulation across the market, or do you think that's just part of the game, and that's how the metrics are read?
Yeah, so I would say a couple of things. So one is human behavior has not changed, and that's the constant, and that's really where on-chain and TA, I believe, always have value. I mean, and it comes down to the data being read correctly, and there was huge mistakes made across the board with analysts in the on-chain space, myself being one of them. So I think for people to disregard on-chain at this point, it's so early in the game. I mean, it's such a new space, an opportunity to get additional data on top of all the other things like macro and on-chain and TA. So, yeah, for me, I just think that it's a new growing sector. There's a lot of new metrics coming out. The interpretation and understanding of these metrics is constantly evolving. There were tons of mistakes made. Like I said, myself being one of them. We learn from our mistakes. We go back and we say, okay, what did we screw up? What do we do different? What do we need to change? And I mean, there's some on-chain metrics that are just not going to hold up over the course of time, and there's some that will. And so that's why, I mean, my goal is always to look at as many as possible that make sense, that seem relevant, and ones that have a good track record. And some of these are going to break, of course. But yeah, we understand why they break, and we kind of look at as many as possible. So, I mean, with on-chain, one of the things that occurred was basically I was actually adjusting some of the floor models. I was actually adjusting them in anticipation that we would see less volatility to the downside just because that had been the trend for some of these metrics, right? So like over time, as the market cap of Bitcoin grows, you would anticipate that there would potentially be less volatility to the upside and the downside. Because of all these external but related factors, in macro and just everything that's occurred in the global economy over the last year or whatever, that is actually, and also the contagion and all these things additionally, that's pushed us down to the same really oversold levels that we've seen on all these historic Bitcoin bottoms. And with on-chain, I mean, it's a very, in my opinion, the best use for on-chain is the health of the network, and then assessing these really large, like these big opportunities on high time frames, multi-year opportunities, and assessing assessing risk on high levels, not day trading. There's lots of other tools for that with TA, but with on-chain, it's more for in my opinion, the long-term investors, that want to assess their risk reward and their essentially their entry risks on high time frames for holding Bitcoin through the multi-year cycles. And so, yeah, that's how I look at it. And with a lot of these metrics now, I mean, they're basically saying that we're at that level. It doesn't mean that you're going to get the perfect entry, if you buy now, but it's not saying to do that. Of course, you still DCA and you got to factor in your own additional risks. But it just gives you it just gives you a hint that okay, we're at a very oversold level on these higher time frames. And so, last thing I'll mention here is just, yeah, I mean, it's funny how I adjusted some of these models, and in the end, what's going to hold up, it looks like, is just the raw models themselves, like these on-chain metrics that were created, 5-6 years ago by guys like Willy Woo and David Puel, like these OGs that created these metrics, years and years ago. A lot of these metrics are actually going to hold up extremely well, in my opinion, or they look, at least right now, they look like they're going to hold up extremely well, unless we go to sub 10K, then they would be breaking. But if the Bitcoin bottom ends up being between 14 and 17K, or sorry, between about 14 and 18K, that's basically where most of these floor models are pointing in the on-chain space. And so far, I mean, we don't know if the bottom's in or not, but if it is, or if we go a little bit lower to 15,000, that's right in the point where some of these models are pointing to the bottom being. And one I'll mention, just last thing I'll mention here is a really cool one that Willy Woo created in 2008, or 2018, I should say, called the Coin Value Days Destroyed. And so that model currently, if you don't adjust it at all, it's saying 15,000. If you adjust it a little bit, it's basically saying 17K. So yeah, the reason why the adjustment is just, if you just leave the raw model, then we don't quite get to the floor on all the previous bottoms. But if you adjust it up 10%, we basically hit the bottom or hit the floor on all the previous bottoms, and that would put us at 17,000. So that one floor model, which is only one model, but it's an interesting one, is hinting between 15 and 17 for the bottom. So, but I mean, again, there's a million other factors. This is only one lens. On-chain's only one tool, and guys like Caleb, speak to the macro, which is obviously a huge factor. So I'll let him share here.
Yeah, absolutely. We're going to throw it right to Caleb Franzen. And just so everybody knows, please go click on his image if you're here on Twitter. If you're listening somewhere else, you can go to his profile, check him out at The Real Plan C. He puts out so much incredible data. And as he mentioned humorously, he went on crypto vacation into Celsius land for a while. But you know what? All of us up here, whether you guys realize it or not, we hold ourselves very highly accountable to the voice that we have in the space. And if we are mentioning or talking about a particular project, then we hold ourselves to at least the people that I bring here on the Crypto Answer and all the guests we have. They're all highly respectable and they hold themselves accountable. And being that he was a major, not only investor in holding Celsius, he also wanted to make sure that the people that he led down that path in any way, if he had any influence on that he got them the information that he needs. So I have a lot of respect for him for basically holding his feet to the fire and do that. But I'm glad to have you back here and talking about on-chain and looking at the charts and all that sort of stuff. I do want to mention, though, you talked about and this is a potential sort of gray area for all of our minds, I think, as analysts, that myself included, we're talking about, as Bitcoin gets bigger, becomes a larger asset class, a lot more money involved, a lot more people there's this expectation in some ways that the volatility is going to shrink. And I was listening. I forget who I was listening to. I think it was Mark Yusko, who's a incredibly smart investor, and he was mentioning how a lot of us, not that we can see a direct comparison or we should use a direct comparison with other assets, but even just looking at Amazon, it's I mean, it is absolutely massive asset, right, in terms of their market cap. And as they've grown, it hasn't diminished the fact that almost every year they have a double digit pullback, and very regularly anywhere from 17 to 35%, almost every year, and sometimes two or three of those pullbacks in a year, despite how big their asset class is. So I think we all need to remain adaptable with how we're interacting with the charts and how we're interacting with where and how and when we're placing or making our investment or trade decisions, because we have to remember Bitcoin is breaking the mold of all asset classes in the history of mankind, because it's built and designed, run, and governed by math, and decentralized, and it's going to break the mold of some of those patterns eventually. So we need to be adaptable in how we interact with it. So with that, I want to throw it off to Mr. Caleb Franzen. He's a frequent guest here on the show. Wonderful mind. I recently got him plugged in with my sort of brother channel, the Crypto Jeb Show on YouTube, and now he seems to be becoming a fixture there as well, because he's incredibly smart. So I'll just send it to you, and you can talk about whatever the heck you're seeing and how you're feeling and what you're feeling, my friend. How you doing, Mr. Caleb?
Hey, I'm doing great, Kelly, and thanks for the introduction. I actually wanted to go back and just really quickly touch on something that you had mentioned in your question of Plan C, which is this kind of concept of more institutional investors kind of growing in this space. And I thought Plan C's response was really strong, which is that, at the end of the day, either whether you're looking at technical analysis, some of the on-chain data, or some of the underlying metrics, human psychology is generally the same. I do want to point out, though, that when we're talking about retail investors versus institutional investors, there is a significant difference in both the challenges that they're facing and how they approach their portfolios. So even though human psychology at the end of the day is the same, when the players are literally a different type of DNA, their psychology is also going to be slightly different. And I think that kind of ties into what you were just saying, too, about how over time we should expect decreased volatility from Bitcoin and likely from the broader crypto space as a whole. And looking at something like Amazon, which benefits from network effects and has a lot of these same kind of exponential adoption drivers, generally speaking, is a decent gauge, I think, for how we could expect Bitcoin volatility to adjust over time. Even with that being said, right, I think Amazon, the annual average drawdown is in excess of 20% to the downside every year. And so when you're looking at an asset or an individual security in this case that has even that degree of volatility on an annual basis, that definitely isn't something that's easy to stomach over time. But how have investors been rewarded for that volatility and for that risk? They've been rewarded massively, right? So for the investor who can keep that long-term conviction, long-term time frame, and continue to stick with those network effects, generally speaking, they should be some of the biggest beneficiaries. So I think that's just kind of first and foremost. I wanted to touch on those because I thought those were really interesting questions and comments. I think, I always try to tie everything back to the macro and specifically to the monetary policy environment. I feel some of my mindset is shifting on some things right now, because I think it's less important to watch the Fed right now as it is to watch the economy. Because I think a lot of the risks that the market has perceived with the Fed and their degree of hawkishness and aggressiveness that's only been increasing all year, we've essentially hit, based on where the market is right now, we've hit a peak in that aggressive, monetary policy environment. Certainly over the next 2 months, we're going to get a lot of very interesting inflation data for the July and August CPI data. So that's certainly going to pose a risk. But I just want to remind that we can't let the tail wag the dog here, right? So the Fed is going to be using the data that we get over the next 7 weeks to make their determination about what to do with interest rates in September. And when I checked earlier this week, the market is basically pricing in a 50-50 chance whether or not the Fed raises by 0.5 percentage points or 0.75 percentage points. And so when we're in this environment right now where the monetary policy environment is essentially stagnating, right? We're not seeing more aggressive tone or policy follow through from the Fed. We really do need to be keeping our pulse on what the economic data is showing us. And so we got the JOLTS data earlier this week. We got the initial unemployment claims data this morning, and both of which are essentially trending towards deterioration, I think is the way that I would put it. So we've seen a continued increase in initial unemployment claims, although continuing unemployment claims remain generally muted. So again, I think this reflects some ability for the labor market to absorb some of these shocks and swift increases in unemployment that we've been seeing a little bit. But then the JOLTS data, surprised pretty significantly to the downside and went essentially from, I think it was 11.1 million to 10.7 million job openings on a month-over-month basis. That's still extremely elevated, but a substantial decline. So from my perspective, the Fed is likely looking at this data and seeing, okay, great, we've raised rates by, 225 basis points. And those effects are now taking place both in the financial system, as we've seen with how asset prices have responded in 2022. And now we're finally starting to see some of the follow through from the economic perspective. So I would just encourage people, definitely be paying attention to tomorrow's non-farm payroll data, specifically looking at the unemployment rate and the prime age labor force participation rate. Both of those, well, not both of them, but the labor force participation rate has been declining slightly, while the unemployment rate has been basically stagnant at 3.6%, I think for the last 3 months off the top of my head. So tomorrow is going to be really big for that, because I think the Fed is still looking at some of the data that we got in the JOLTS report and still seeing that we're really in this wage price spiral dynamic, which is something that I've been talking about really since like early May.
Well, one of the things I saw a message the other day on. First off, actually, I want to say that was a really, really great sort of. Thank you for sharing your thesis, and I mean, your context of all of it is so wonderfully articulated. I appreciate you on here. And so, anybody, if you haven't yet, definitely give him a follow. It's at Caleb Franzen, CalebFranzen. He's got a lot of great stuff that he's always putting out. But I wanted to ask you. Following, of course, we had the 75 basis points hike the other day, I guess about almost 2 weeks ago now, and the basically the press conference, Chair Powell basically came on and was perceptively, at least in some people's opinion, very dovish in terms of how he was approaching, what was going on, which in a way sort of everybody was expecting 75 basis points to a full, basically 100 basis points. And so coming in at 75 and then also getting the dovish sort of remarks kind of buoyed the market a bit. However, I did see an article about, I guess about 3 days ago, and who knows if it was a narrative piece or if it actually had some veracity, but it was basically discussing that basically state feds as well as other people that are, because people have to remember the Fed it's not just Chair Powell's decision. He's basically on a board of directors essentially, that they all come to agreement about, and voting and what that decision is going to be. But essentially they were trying to walk back a little bit of the dovishness that was perceived, and that the 10-year rates essentially were going up to sort of offset this dovish sort of nature. I'm just curious what your thoughts are on that, and if you're seeing that, and how you think that's playing into what's going on right now.
Great question, Kelly. So I've been, outspoken the entire year to expect a hawkish Fed. And from my perspective, last week's press conference was the most dovish tone that we've heard directly from Powell, and essentially in a formal chairman speech, right, if you will. But so first and foremost, I think that is important, and markets have been celebrating the fact that we got that dovish tone out of Powell. And one thing that I have been saying all year is that forward guidance and their rhetoric is a policy tool, right? But while that is a policy tool, it's not necessarily indicative of what they're going to do with interest rates or balance sheet runoff, right? Because the one thing that the Fed always tells us, regardless of how much we believe it or not, is that they're going to be data dependent and wait to see how incoming data reflects the actions that they've already taken thus far, right? But to your point, it has been very interesting to see whether we're talking about Bullard, whether we're talking about Kashkari. We had comments from Loretta Mester earlier this week and even today, basically planting the flag down again in somewhat of a hawkish stance. And so I think you're totally right. We have seen some of Powell's comments be walked back a little bit, back towards that hawkish territory. And I think surprisingly, though, over the last couple of days since those comments have come out, it's really been just this week. But markets have still been ripping higher. And this has been an interesting little dichotomy, which is also why I said in some of the first comments that I made on this call is that I think right now it's becoming less about the Fed and more about the economy, right? Because the market is seemingly pricing in and digesting all of the hawkishness and or all of the dovishness that the Fed is providing, right? Regardless of whether it's hawkish or dovish, the markets are just celebrating and running higher. And so a lot of that, I think, is going to put more and more pressure on the economic data to show that we aren't heading into a recession. There seems to be this perception that a recession is going to be good for asset prices because the Fed is going to pivot. I mean, show me one recession where assets, rose during that recession instead of fell. In every time we've had an increase in the U6 unemployment rate, specifically in the rate of change of that unemployment rate, asset prices fall. There's an inverse correlation there. And so when we look at the market and the economy today, whether or not we're in a recession right now is certainly up for debate. But the one thing that we know for sure is that we haven't seen a deterioration in the labor market that would be congruent with a recession. And so if we do move further towards a recession, officially, let's say, and we do see a follow through of weakness in the labor market, that's not going to be good for asset prices in the short term, regardless of whether or not the Fed pivots, right? The Fed started printing a bunch of money in early March of 2020, but we still fell like 20% until the market finally bottomed. So eventually we'll reach a bottom once the Fed pivots, but a recession in and of itself is certainly not good for asset prices. So we need to be looking forward to relatively stronger economic data, because the sooner we get good economic data and inflation starting to fall back down towards its long-term historical trend of 2%, the Fed's long-term target of 2%, the sooner we get out of a Fed tightening cycle, if you will, right? So I think generally speaking, as a community, we all need to be hoping for resilient economic data and a downtrend in inflation.
Man, if I could just pick your brain for about 67 weeks, I might get to about 6% of the knowledge base that you're at. I've got a good grasp on things, and then I start listening to people like you, and I'm sitting over here with the notebook open, trying to write as fast as I can. It's such a brilliant mind. I love having you on the show. I love the friendship that we built on this. And again, I want to shout out to everybody that's tuned in here to Crypto Answered. Thank you for tuning in. We're here every Thursday. Most Thursdays it's a 7 p.m. Eastern Standard Time. About once basically we're trying to do the first Thursday every month, midday, 2 p.m. Eastern Standard Time show. So we give access to people overseas. That's both guests and people tuning in to listen. Start looking out for us on basically the podcast areas as well. If you can't tune in here, you'll be able to find us on Spotify and Apple Music and iHeartRadio and all those things. And that's brought to you by PennyFly Entertainment. So definitely go give them a follow. That's at PennyFlyent. They are going to be doing a $100 giveaway as well. So definitely go ahead and go give them a follow, and you'll get the details on that. But before we wrap out, again, I want to say thank you to everybody. I want to open up the floor to a couple of questions for the last 10 minutes or so. It looks like we got 2 or 3 people. I'll try to get through all 3. We may only get through 2. So thank you again, everybody, for tuning in. Again, my name's Kelly Kellam. You can find me at Kelly Kellam on Twitter. And thank you again. So I'm going to be bringing up Power. Power's a frequent listener. I think he's come up to speak before in the past. He just disappeared, so I'm not sure where he went. So we're going to be moving on to Tabriz. And sorry, I think that's how you say the name. Add as speaker. So when you come up, just please try to keep your question or comment sort of succinct and either directed or, just that way we can allow another person or two to hop up. And again, thank you for joining. What's your thoughts? You're welcome to speak now, my friend.
Thank you. It was an honor, and it's amazing to listen to everyone over here in this bear market. Hats off. It's and just my question. I was just just spoke my mind because the Fed is the data dependent, and we just now looking for the labor market, to show us some weakness or strength, and that will make things forward. And we have that on Friday tomorrow, the non-farm payroll. And my question is, Bitcoin has never experienced a recession before, and I think it will be bad. But any thoughts on that? And I know there's a speculation we have hit the bottom, and same like we were supposed to hit 100,000. So first time Bitcoin in recession. Just thoughts. Thank you for giving me to speak.
Of course. No, thank you for coming up. That's a great question. I'm going to throw it to Plan C if you have any thoughts on that first, and then I'll let Caleb follow on with any other additional thoughts in terms of Bitcoin's relationship now with interactivity with dealing with being in a recession.
Caleb might be better to speak to that than myself. I didn't. Sorry, I didn't quite get the question.
I'm
Oh,
happy.
no problem.
I'm
Go
happy
ahead,
to field
brother.
it. So I don't know. I think generally speaking, you could kind of classify. I mean, you certainly could classify Q1 and maybe even part of Q2 of 2020 as a recession, which Bitcoin was around and experienced that, right? And we had a massive decline. I think we basically fell from like 10,000 to 3,000 during that process. I think generally speaking for markets across the board, though, this is it's not going to be a first, but for the first time in a very long time, markets are having to grapple with and reconcile with recession risks and a Fed tightening risk, because stagflation has essentially been absent from the economy since the 70s, right? And then we ended up going into somewhat of a hyperinflationary period towards the tail end of the 70s and into the early 80s. And I mean, if you look generally speaking at how risk assets and equities performed during that period, it was very poor, right? So essentially, the risk premium went up very high. So if you were a buyer of assets during that time, you got to experience arguably the greatest bull run in financial market history over a 30 to a 40-year period, obviously with its own ups and downs. But generally speaking, during that time, the biggest beneficiary was real assets. So whether we're talking about gold and commodities, or if we're talking about real estate, right? But during that time, bonds, stocks, everything else was just bleeding to the downside. And so if we did get into somewhat of a stagflationary environment, which I think has been an increasing risk throughout the year, it was something that I warned about in October of 2021. I did a post saying that my biggest fear right now is the Fed seems to be tightening into weakening economic growth. I didn't expect that quote unquote weakening economic growth to turn into an outright contraction so fast, but here we are, right? And so, if we do go into that stagflationary environment, Bitcoin, generally speaking, I may view it as somewhat of a commodity in terms of it being tied to compute power and the hash rate of the monetary network. But the market, both for traditional and retail investors, generally speaking, don't see it that way. They view Bitcoin as basically leveraged tech stocks, right? And you can see those correlations and point to why that could be true or not. And it's certainly up for debate. But regardless, I think I wanted to mention this earlier as well, which is that tomorrow's labor market data is going to be very important, because if we see somehow that the unemployment rate remains stagnant at 3.6%, or I mean, it'd be crazy, but let's say it decreases to 3.4% or something like that, or the labor market is still really strong, the Fed is going to be scratching their head, and excuse my language, but they're going to be like, what the fuck is happening? How are we tightening this much and we're still seeing so much strength in the labor market? This does not make sense, right? And so if they do that, if that happens and we do continue to see strong labor market data, the Fed is really going to be emboldened to continue to act more aggressively. So as terrible as it sounds, the Fed really is looking for a slight deterioration in the labor market in order to bring demand and re-equilibrate it at a lower price. So that's essentially their mission. The interesting thing is, Powell, in his comments last week, said essentially that we don't necessarily need a recession. And so, I think that could be true, but a recession would certainly help to bring inflation down, assuming that we don't enter into a full-on stagflationary period, which is a growing risk, like I said.
Oh yeah, that's such great points, and thank you, Tabriz, for the question. I actually have I think I got a good last question that I'd love for you to sort of tackle here, Caleb, because you have such a great broad sort of understanding of the market. You know, one of the huge things that drove us obviously into the major sort of recession period in 2008 was the housing crisis. And some people, I've been seeing a lot of different people post about things going on in the housing market right now. However, I would sort of theorize that the setup right now going on in the housing market is very different than it was in 2008, because at that point it had to do with subprime lending, all these different sorts of things, and it was a difference in demand. Now, with the massive pandemic that we just had, people moving out of cities. Even in New York, just right outside the city, housing prices went up ridiculously. And then as soon as people came back to the city, the rents basically doubled in the average price and that sort of thing. Also in Florida, Florida and other major markets, housing prices went up so dramatically, and now they're pulling back. And so, on one hand, it looks like that there's this massive decline, but in reality, it seems to me like that massive pump would be a little bit kind of like a black swan to the downside, as we saw in assets in March 2020. The demand was a bit of a or a white swan, I suppose, for housing and other things like lumber and other things, that the value just dramatically exponentially increased relatively to where they have been. And so now that it's correcting, I'm just curious how you're sort of tackling your thoughts on this argument or these ideas or fear of the housing prices collapsing, when, for instance, I see them just kind of coming back mean reversion.
Sure. Great question, loaded question for sure. So I'm happy to take this in a couple of different ways. The first thing that I would like to point out is just to reaffirm what you said about the lack of subprime lending in the current market versus where we were in 2008. If we look at the most recent data right now for mortgage originations by credit score, roughly 60% of mortgage originations right now are to creditors or to borrowers with a credit score larger than 760. That is extremely strong. Whereas back in 2006 and 2007, it was roughly 20% versus 60% today, right? So banks are lending to significantly stronger borrowers in today's environment than they were in the past. With that being said, the dynamics that possibly led to the bursting of the housing market in 2007 and 2008 really started happening in 2005 when the Fed first started raising interest rates off of a floor, right? And so in every kind of boom and bust of a credit cycle or economic cycle or business cycle, the Fed ends up bursting whatever that bubble is, if you will, because they start tightening late into the credit cycle. And so when you've had everyone get drunk on cheap money and then start to become over indebted, if you will, it becomes difficult to service that debt at a higher interest rate, and you start to see weakness across the market. I think right now, I'm not seeing that weakness across the market. Credit availability is still extremely strong. Banks are lending at a historic rate. Consumers have easy access to credit, so on and so forth, right? If we look at delinquencies, they're at or near all-time lows. If we look at forbearance, all of these things are basically at or near all-time lows. And so that is an interesting thing to pay attention to. The one thing that seems to certainly be the case is we are finally starting to see some weakness in terms of home prices and home activity. So if we look at either new or existing home sales, they both came in way below estimates and way below prior month data. So we're seeing far less transactions. We're seeing a lot more homes actually come onto the market. So one of the things that was essentially propping up the strength in housing has been such limited and record low inventories. So when there's no supply, even if there's very little demand, prices can remain elevated. But if that demand stays relatively low or even decreases, but then supply goes way up, then you really get a decrease in the price, right? And so that's exactly what we're seeing. We just got the 1 month rate of change in the median home price, and it was the fastest deceleration to the downside, so the fastest month over month decrease since 2008. right? So that's yeah, I mean, that's not necessarily a good sign when we're seeing the fastest 1 month or 2 month annualized rate of change to the downside. So I think, you know, we are starting to see that weakness unequivocally come into the housing market, and that's definitely going to be something to kind of keep a pulse and an eye on, because that's essentially been the only safe haven for investors in 2002. But now starting to see weakness there, that's going to be very important, because one of the biggest it's going to be important for a lot of reasons, and one of them is because if collateral values start to go down, people are going to have even less access to new capital. That's what I wanted to say.
Man, yeah, I never thought when I first got my first Bitcoin purchase, 6 years ago, that I was going to be so interested and just ready to dive in so deeply on talking about housing markets, equities, commodities, the price of lumber. Think that even at that point, think that it had anything to do with what I was doing in crypto. But the longer I've been in this, and I hope everybody, if you're wondering why we're talking about these things when this is a show called Crypto Answered, is because the longer you're in this, the more you see all these things are interconnected, and everything works in balance and in tandem with each other. And depending on the fundamental shifts in those, and also the changes in the basically not only the market base but geopolitics, regulation, all these, how you position yourself is governed by what knowledge you have, and what knowledge you have on an asset specific only to that asset doesn't give you any. Basically, it's like walking around with blinders on because you're not seeing all the things that are affecting what's in your path. So that's why a good portion of the show we're talking about all these things that don't seem like they fit into this Bitcoin picture, but as everybody's found out in this last year, especially the last 7 months, that there's a lot of things on the table, and all these things are interacting. So I want to say thank you for everybody that's tuning in, or that's tuned in here on Crypto Answered. Uh, and again, thank you to the Real Plan C, at the Real Plan C, Caleb Franzen at Caleb Franzen. We also had Crypto Burb at Crypto_Burb, as well as who else do we have? At Gert Van Lagen. And then, of course, Harry, I want you to wrap us out. If you have any final thoughts, I don't know if you can speak. I know you're also on a call. You could wrap us out with any final thoughts you have on the market, and any more announcements about the PennyFly giveaway. Yeah, I think you might still be on the call. So big love to everybody. Thank you so much for tuning in. Hope you all have a wonderful, wonderful week. Again, this show is brought to you by PennyFly Entertainment at PennyFly ENT. And we will see you again next week. We'll be here next Thursday on 7 p.m. Eastern Standard Time with another great panel, and hopefully more time that we can carve out to get a lot more AMA going on the next session. So again, everybody have a wonderful weekend. My name is Kellam, and I will see you at the next Crypto Answered. Adios, everybody.